Welcome to the Unlimit podcast, brought to you by Bitcoin Unlimited. I'm John Moriarty, and for today's episode, I have with me co-founder and CEO at CoinFlex, Mark Lamb. Mark, thank you for joining me.
Great to be here. Thanks so much for having me.
So, CoinFlex is a cryptocurrency exchange with some unique features and capabilities, isn't it?
Yeah, absolutely. And CoinFlex started off as a crypto exchange 2 years ago as a spinoff from my last exchange, CoinFloor, which is still one of the main UK exchanges for spot. And we kind of have over time realized that our real focus should be these interest products. And so we've focused on stablecoins actually. And we've created the first interest earning stablecoins. So what that means is that it's a $1 instrument, but while you hold it, it pays you interest every day or multiple times a day even.
Very cool. And so is that what you're talking about when you talk about CoinFlex having the first physically delivered futures or anything like that? Or is that something separate?
Kind of. So that's something separate, but that's really what allowed us to create FlexUSD, the stablecoin. So physical futures are a massive thing in traditional futures markets. They're how the majority of volume trades and clears in traditional markets. And so far in crypto, cash settled futures have been the predominant futures volume instruments. But really, we created the first physical futures, and we were kind of looking for an ideal user of them. And I think there was a lot of things we learned along the way as to why that user didn't exist, and then we realized that user did exist in the form of a stablecoin. So what a physically delivered future does is it allows you to be absolutely certain of a buying spot selling futures arbitrage. And that arbitrage is called the basis trade. So the basis trade is basically when you're buying a Bitcoin.
Now, I'm going to even interrupt you there and ask, could you maybe say that first sentence again and elaborate on it just a little bit for people like me where it might go over their heads?
Yeah, sure. So a futures contract is ultimately a contract with an expiry date. So it could be the end of March. And it's a contract where you're buying something in the future. So similar to how you might buy something with a credit card, the power of a credit card is allows you to pay later for something, but lock in the purchase now. And in this case, or a mortgage is kind of similar. In this case, you don't get the thing until you've paid for it. So you get it at the time of the expiry of the contract. But you can lock in a price today. So if Bitcoin goes up, and you've bought futures today for the end of March, and you paid $55,000 for them, and Bitcoin goes up to $70,000, well, you've just made $15,000 per Bitcoin. And in our case, you can actually pay the cash, pay $55,000, and get one Bitcoin at that time in the end of March. And so the thing that this does, and futures typically trade at a premium to spot, and that's because people are levered and they want to use the leverage that futures create, because futures are
Okay, and I'm even going to stop you there again. I apologize. But when we say that they're levered, and could you explain what that even means?
Yeah, sure. So people don't understand the term leverage, but it's again going back to the credit card thing. Let's say someone with $100 in their bank account can spend $1,000 on a TV. That's leverage, right? Or let's say someone has a salary that they're able to use as evidence that they can buy $1 million house, but they don't have $1 million. That's leverage. And so leverage is really refers to any type of loan, including loans that could be somewhat synthetic in nature. So in the case of the house, the bank is actually loaning you money to buy a physical house. In the case of a futures contract, there is no loan that's happening per se, but what's happening is that market participants only have to put down $100 per every $10,000 that they spend. So there's 100x leverage to the contract. So obviously using 100x, meaning putting down 100 and spending $10,000, is pretty dangerous, because if markets move 1%, you're going to get liquidated, even slightly before 1%. But using 5x, using a 10x, something like that, This is common for traders to try to enhance their returns, and it also lowers their counterparty risk because they can keep less money on the exchange.
And I'm sorry, lowers their what?
Counterparty risk, because they
Counterparty
can
risk.
keep
Gotcha. Thank you.
less money on any specific exchange. They can do more trading. Really, it just enables people to do more trading. And so the power of that is that, buyers of Bitcoin often decide to pay above market for the price. Buyers of Bitcoin Cash, buyers of all these instruments pay a premium to the price of the spot, because with spot you have to fully fund, and it's just 1-to-1. There's no leverage. But with futures, there can be very high leverage, and so what that means is that premium ends up being kind of a funding cost. So now FlexUSD takes the other side of that bet and says, FlexUSD has to be stable. It has to be always worth $1, but it's happy to buy spot and sell perpetual, and then deliver that position. So get back into dollars.
Okay, now, to buy spot, if you could explain
buy
what that
one
means.
Bitcoin. Sorry. So yeah, I think spot market is Bitcoin, US dollar, Bitcoin, USDC, Bitcoin.
And specifically, that means the current price, right? If they're talking about the spot price.
Yeah. So when you think about these derivative instruments, it kind of is like a curve out into the future. And so you have this now instrument, which is spot. If I buy one Bitcoin, I take it off platform immediately. I can withdraw it immediately. The perpetual is an instrument where it looks like the spot price, it feels like the spot price, but it's an 8-hour instrument, and it's a rolling instrument, and it's an instrument that has leverage in it, and so that's why it trades at these premiums. But it's also an instrument that is relatively short term, and so it has these funding payments every 8 hours, and these funding payments can get quite massive on other exchanges. So on Binance in the last few weeks, those payments were often 100% annualized or 150% annualized.
And could you explain what that means? That you said they're large, but what were the payments coming from?
So the payments are coming from people that want to be long. So ultimately,
and even I'll stop you again. People who want to be long, that just say people who want the price, who think the price will go up and want to bet on it.
People who are betting on the price going up. So this is not people who are buying Bitcoin. This is people that are making a derivative bet. They're making a contractual bet on these exchanges that the price will go up. And the interesting thing about this bet is the other side of the bet is often people that are doing this type of basis trade. So they're buying Bitcoins and they're selling these contracts, and they're trying to collect this 100% annualized premium. And the cool thing
I apologize, 100% annualized premium. Could you explain how that works or what that even means?
So what that means is if you there were days where the premium was often at a rate where if it remained at that rate over a year, you would make 100% on your US dollars. So it was just kind of 10% a month, over a year, you make well over 100% on your dollars. And during that time, CoinFlex rates were kind of 20 to 30%. And the FlexUSD interest rates were 20 to 30% as well. Sometimes they spiked up to 40%, but they were pretty consistently 20 to 30%. So what that means is someone who is long Bitcoin or Bitcoin Cash or Ethereum or any crypto was way better off having that long position on CoinFlex than on Binance, because there's the trading fees, and sure, you might pay a similar trading fee, and we're less liquid, so you'll pay a bit more slippage on CoinFlex than on Binance. But if you're holding your position for a few days, anything more than a day really, you're going to really notice that difference, because that difference is going to make a huge difference to your P&L, to your profit and loss, to your expected gains that you make on this trade. And the other cool thing about it is, if you're not a trader, if you don't like derivatives, you don't want to understand how these things work or be 10x levered long, well, that's okay too. But maybe you have some dollars, and maybe you want to earn from these people that are doing these things, and maybe you're comfortable with these mechanisms such that you want to mint some FlexUSD. or you want to go to SideShift and buy some FlexUSD. And that's really what we're trying to create. Is there are 30 billion, almost 40 billion now dollars worth of stablecoins. All of these coins, all of this money is earning 0%. If this money was earning a couple percent or 5% or 10%, there would be more money trading crypto. That's just the fact. Because when people look at the crypto space, they see a lot of things. They see chaos, volatility, they see excitement, they see the passion of thousands and tens of thousands of entrepreneurs worldwide. They see a group of people that's really unafraid of borders and boundaries and is trying to build things in a permissionless way. But they also see really high interest rates on US dollars. And those interest rates right now often require an algo trading team to take advantage of them, or they require knowledge about DeFi, or they require this or that. Well, what we're trying to create is an ecosystem where those interest rates just require minting. Just clicking one button should be all you need to do in order to access, the amazing things that the crypto markets have to offer. So yeah, that's what we've created. And then we've created the same thing for these trading firm nodes as well. So trading firms borrow capital. It's often a great deal, great business to lend to them. They pay 10% plus or 8% plus fixed. We also give a cut of the trading fees. And we want to make it such that lending to them is also just a click of the button.
And these trading fees and these payouts, these are going to holders of FlexUSD, is that right?
So the repo interest, the perpetual funding interest is all going to holders of FlexUSD. And so what that means is as interest rates go up on CoinFlex and people are chasing those returns and chasing Bitcoin going to higher and higher prices, basically FlexUSD holders just get paid more and more. And so it creates this very positive relationship between stablecoin holders and the exchange, because everyone's winning. The traders that are long on our exchange are getting a much better deal than if they were long on Binance or any other exchange. And they can even do arbitrage. They can buy ours and sell theirs. And then the people who are just holding stablecoins are way better off than if they were holding Tether or USDC or any of the other stablecoins, because they're actually getting paid yield, whereas elsewhere they're not.
Very cool. Yeah, I mean, that sounds like the sort of thing that could be explosive in the number of people, both, using crypto, but even also just specifically Flexcoin or FlexUSD. And maybe that would be a good thing to talk about now is okay, so you've got Flexcoin and FlexUSD. So FlexUSD is a US dollar stablecoin. How about Flexcoin? Could you tell us a little bit about that?
Yeah, so Flexcoin really tracks the growth of the exchange and the growth of CoinFlex as a business. So ultimately, Flexcoin is basically the currency that all fees are denominated in. And you can pay fees in dollars, but any serious trader pays fees in Flex because it's 2 to 3 times more expensive to use USD as a fee paying currency. And so Flexcoin is basically, it's also something where we take 20% of profits and we burn them in Flex. So if they're not already in Flex, we buy Flex and then we burn the Flexcoin of those profits. So there is a tie-in to the company's performance. There's a tie-in to the trade volumes on the exchange. That's probably the biggest tie-in. And over time, there's going to be more and more tie-ins to everything we're doing. And so, ultimately, our goal is to create the note token market and the FlexUSD market and make these grow to be really, really large. And if these grow, we will be the biggest exchange because we'll have the cheapest perp funding, we'll have the cheapest basis, but we'll also have the cheapest ways to borrow money as a sophisticated institutional trading firm, and all on the behalf of very happy stablecoin holders that are getting a better deal than they would get from other stablecoins. And then the end result is, they'll pay lots of fees and they'll trade high volumes, and then CoinFlex will be very profitable. And so we've already burned about over 1 million Flex, which is 1% of the supply. And we're just going to be burning and burning and burning until, hopefully very little of the supply is left.
Very cool. So I think it's maybe kind of interesting. So I'll just point it out and let me know if you have any thoughts. Just the fact that so there are exchange tokens already, and even just being required to pay fees, or maybe not required, but being much less expensive on popular exchanges, that's led to some enormous successes in that area. So there's BNB and Binance Coin, and I'm sure many others. But how much do you think that the answer is probably a lot, but how much do you think that this interest-bearing nature of them will give you an edge in that market?
Well, I think the fact that FlexUSD and NoteUSD are interest-bearing means that capital, even capital that doesn't care about crypto, is going to start coming in. And so the end result of that is going to be that our exchange becomes a place that has capital available on it in the form of repo and perp funding and also real funding that no other exchange has. And so no exchange is doing this. No exchange is focusing on stablecoins really in a serious way. No stablecoin company is focusing on interest rate stuff. And really, exchanges are not focusing on the borrow-lend market or the market for borrowing capital in a collateralized or an under-collateralized way. I think that's the biggest flaw of every competitor of mine, and I'm very happy about it because I think it's an edge we have. But it is really this is the biggest market in crypto already today. If you think about stablecoins, it's bigger than derivatives in terms of open interest. Stablecoins are, almost 40 billion now. If you think about borrowing and lending, it's becoming enormous. In DeFi and CeFi, it's absolutely enormous. And it's all mostly often done in very manual ways. If you look at many of the borrow lend desks, it's very manual. You message them on Telegram, you ask them, hey, we want to borrow this, we want to borrow that. And transactions happen mostly OTC. So we're trying to automate, make transparent, and make accessible to all everything in the borrow lend space. So, and the borrow lend space is something really that most consumers are not aware of what's happening behind the scenes. So if you go to BlockFi, they'll pay you 8% on your USD, or they'll pay you some percent on your Bitcoin. How are they getting that? People don't know. And then they hear BlockFi is one of the biggest owners of GBTC, and GBTC is at a negative premium. And does that cause issues? I don't know.
And could you explain what that means to be at a negative premium?
So the Grayscale Bitcoin Trust is something that usually trades at a premium to spot. So it's kind of like the futures in that it trades at a premium. And it trades at a premium for similar reasons to the futures, because people are bullish. They want to buy out of a retirement account or a tax advantaged account. And GBTC is one of the only ways to do that. The thing right now that's interesting is in this recent pullback, Grayscale Bitcoin Trust has started trading on exchanges, on traditional stock exchanges, at a negative premium. So it's trading at a discount to the Bitcoin price. And there's no arbitrage. There's no way to buy a share and convert it back into a Bitcoin and do the arbitrage.
And even that, actually, I apologize. You've mentioned the word a couple times, but could you also explain just very briefly what it would mean for someone to do arbitrage?
Yeah, sorry, I've been in crypto markets for like almost 10 years.
There's a lot of jargon.
Arbitrage is like the first thing I learned. Arbitrage is anytime you're able to buy something somewhere and sell the same thing somewhere else at a higher price. So apples are trading $2 at a street market over here, and you can go over to another street market and sell apples for $3. You buy as many apples as you can for $2. You sell all of them for $3, make $1 per apple. It's not a crypto term. It's just a finance term, but it's been around for thousands of years. Arbitrage is
sure. And the effect of that is, excuse me, and the effect of that is that prices then eventually reach an equilibrium. Is that right?
Yeah. Or yeah. The effect of that is that the guy who's willing to sell at 2 is happy because he was able to sell at 2. And the guy who's willing to buy at 3 is happy because they're willing to buy at 3. and they may not have known about each other. There may have been time distance between them. So you might have literally been doing something as simple as a courier service. There might have been risk involved in taking the apples from one location to another location. And that's what you see in crypto finance as well. So there's interest rate differences between exchanges that might represent counterparty risk. Maybe Binance's 100% plus represents counterparty risk, or maybe it just represents their perp contracts are not physically delivered. And so people will do these arbitrages and try to deal with these differences in risks, differences in contract structure, differences in all sorts of things. And they have to take that on, and they might make money, they might lose money. A lot of people thought that creating Grayscale Bitcoin, creating units, creating shares in this trust was something they could do risklessly. It was something where they could just put one Bitcoin in, or the minimum amount is, I think, is $25,000. But now one Bitcoin qualifies for that. But they put one Bitcoin in, wait 6 months to be able to sell it, and they could sell it for more than one Bitcoin. So a lot of people, including institutions, including lending desks, thought that they could put their customers' Bitcoin in the trust, wait 6 months, and sell it at higher than the Bitcoin price. And the danger when you assume something like that is that premium is not guaranteed to still exist in 6 months' time. So if you're promising your customers a fixed percent return and you're putting their money into a Grayscale Bitcoin trust, you do have a potential issue on your hands, because what can happen is if that premium erodes, as has now happened for the first time in history, to a discount, well, when comes time for you to sell your shares, you have to sell at a discount. And that's because the Grayscale instrument is not a very arbitrageable instrument. One, you have to wait 6 months to create shares. You have to wait 6 months before you can sell them. Two, if it trades at a discount to the expected value, to the Bitcoin price, there's nothing you can do. There is no way to take those shares and convert them back into Bitcoin. There is only one situation where the shares will be converted back into Bitcoin, which is where the trust has broken down and has been shut down or has been kind of disbanded and everyone's getting distributions. And in that situation alone, you can go the other way. You can take shares to the trust and get back Bitcoins. But other than that situation, it just has to trade at the open market price. And so it trades at a couple percent discount in the last week, but that could easily go much lower than that, depending on how eager people are to get out. So this is why what we're doing is really important for lenders in crypto. And I think lenders are the biggest group of users. Not everyone trades derivatives. If you're listening to this, you probably don't trade derivatives. Maybe you do occasionally, but I'm guessing you either don't or you don't trade them seriously, which is fine. Not everyone is trading spot even every day. Not, people often make their bets in Bitcoin. They buy some Bitcoin Cash, some Ethereum, some Bitcoin, and then they sit on them for a while. They sit on those bets. They make those investments and they hodl for a long time, a year maybe. Well, then you're not an exchange user for 364 days out of the year. But what they are is they're holders of assets. They're holders of dollars, crypto, etc. And so what we're trying to create is tokens where you can hold your assets, you can store your wealth, but you can do so in a way where you're earning interest on it. And you're not earning interest in a way where you're just hoping that CoinFlex has some magic formula behind the scenes to make you 7%, 8% on your money. No, we're telling you exactly what we're making. We're telling you exactly what we're doing. And we're paying you out the rate that we're getting effectively, minus a 10% cut for FlexUSD. And this makes it so much more transparent and so much more tradable. We've launched a DEX as well, where you can trade these instruments on a decentralized venue. And the end result of all this is that borrow lend markets become bigger because they're more transparent and they're more open.
Very cool. And just to get back quickly to the point you mentioned before, so Flex or all of your instruments are arbitrageable, are able to be arbitrated, and that's an advantage then. Very cool. So you also mentioned a couple of minutes ago, I think it was Note USD, and so this is something a little different, I guess. Is this related to Notes.finance, I assume?
Yeah, this is. So Note USD is an instrument that lends directly to trading firms that are making markets on CoinFlex. So every exchange has what's called a market maker, and a market maker is doing something similar to arbitrage, and in some cases is doing arbitrage, but they're more like the actual merchant in the stall that is buying and selling the apples. And so what they're doing is they're quoting prices. They're saying, I'm willing to buy Bitcoin for $55,100, and I'm also willing to sell it for $55,200. And same for Bitcoin Cash, same for Ethereum at these prices. And they're updating these prices algorithmically via bots. And when they get filled on an order, when they end up buying some Bitcoin, they rush to other exchanges to try to sell that Bitcoin elsewhere, or they'll adjust their quotes elsewhere to be more aggressive to the sell side so that they can try to sell that Bitcoin. And they're often trying to make $10 per Bitcoin, or 10 cents per BCH, on each trade, but they're trying to do huge volumes a day. So we talk to these firms that are doing $1 billion a day across the global exchange volume space, and they're trying to eke out a small edge. But when you multiply that small edge times billions of dollars, it becomes a very, very handsome profit for them. So what we're doing is we're saying, we know these guys, we see them on the exchange trading every day. They have volume obligations they have to do in order to borrow. You have to be a big enough trading firm that's making markets in large size and actively. And once you are a market maker that's actively making markets, you can, we've vetted your financials. We know you, we know your team. We've done KYC. You can borrow capital from the exchange effectively. And that capital is then raised in the form of a token. So there's two things going on with this token. One, we're lending the trading firm capital, and two, users on the exchange are buying this promissory note, and they're buying this loan effectively. And so users end up getting the cash flows related to this loan to this trading firm. And it's very powerful because these trading firms are often able to make 100% annualized. And so they're very happy to share 8 or 10 or 12% with the token holders on the other side. And we also pay 30% of the firm's trading fees. So the firms are active traders on CoinFlex, often trading millions of dollars or tens of millions of dollars a day. Well, we're happy to share out their trading fees and give users a cut. And that cut then becomes effectively an interest rate on top of the fixed rate they're getting. So you see these notes, they go for 8 or 10%, but the effective interest rate is much, much higher than that. And that's because of the 30% cut. And then you take this instrument and you put it in our DEX, which is a decentralized exchange, which is on the Ethereum blockchain. And basically the end result of that is that you can then earn much higher yields from farming rewards. And this is the Flex coin that we're paying out to early users of this DEX.
So the DEX is paying out Flex coin. The promissory notes are unique tokens specifically to the institution that is currently doing the borrowing.
Exactly.
And then when they do that borrowing, sorry, just one more question then. Does it, to a user on CoinFlex or on notes.finance, does it just like they're buying this note, so they buy it with BCH or USD or?
Yeah, and even better than that, you can actually buy an aggregator index of these notes. So that's Note USD. So if you don't know these firms and you just want to trust, hey, I'll let CoinFlex do the selecting. I'll let their vetting processes handle all this. You can just buy Note USD, which aggregates a number of these note tokens and just buys a number of these note tokens and collects the yields and distributes them out on chain. And so, yeah, we're trying to replicate the financial system, but do it in a decentralized way. Do it in a way where it's accessible to everyone through decentralization, and it's open in the style of crypto natives. It's open and completely transparent on how exactly everything works.
I think that's been a common theme so far, is that it seems like you guys are trying to make it easy. You say one click, make it so that it's accessible to everybody. And I think that's fantastic. Of course, maybe it also would be worth pointing out that some of these instruments are probably technically not legal for certain people in certain countries to use, and so that's something I assume that will be that is addressed like on your site when people connect or whatever.
No, not really. So the cool thing, so futures are something we can't offer to Americans. So CoinFlex.com as a platform is something we can't offer to Americans. Promissory notes and note tokens are not securities in almost every jurisdiction on Earth, including the US. And so we still can't offer the CoinFlex platform to many countries, including the US. But notes.finance as a DEX is not specifically offered by CoinFlex. It's offered by the Ethereum blockchain. And so it's a decentralized exchange. We can't shut it down. We can tell people, hey, use it like this or use it like that. But once it's live, it's live. And you're not trading with us there. So any user anywhere in the world can go to that front end and can trade. And there's not really any geo restrictions there yet. And I don't envision there to be. And you're using Ethereum blockchain to trade. So you're not custodying assets with us. You're buying these note tokens. You're buying these Flex USD on the Ethereum blockchain. You're trading with people on that blockchain, and you're holding custody of everything you do the entire time. So there are no restrictions on notes.finance, and that's something we're really excited about as well, because we do believe that in order for this to work at scale, it does kind of need to work for lots of people around the world without things like KYC and without things like these kind of geo restrictions. And KYC is a great thing for centralized exchanges, but one of the powerful things about decentralized exchanges is that they don't require KYC, because ultimately you want to be able to transact without friction. It's just a friction point. It's just a point where people get afraid and a point where people get limited from trading. And so it's very powerful to be able to offer these things without that hindrance.
Sure. So let's go back a little bit to the dividend payments that you're making to holders of these tokens. So this one, I assume, is particularly possible because of Bitcoin Cash's low fees. Could you explain a little bit more about how these dividends are paid?
Yeah, so we used a version of the dividend tool to pay these interest payments. And basically, we're just looking at all the UTXOs, all the unspent outputs, all the holders of the coins. And then we're looking at that on the blockchain. And then we're making a transaction that batches together a bunch of payments to a bunch of these addresses. And so it's very simple. It's a very simple architecture. It doesn't, on the BCH side, it doesn't require any smart contracting. It's just a little payment that happens once a day. And the cool thing about that is actually we've become one of the highest transaction volume SLP tokens because of these interest payments, because they're kind of widely held, and then people start collecting the interest payments, and then we end up as one of the highest volume tokens on the BCH network. But it is really amazing about BCH that it can handle this many small transactions. I mean, we've paid interest as low as less than a penny to users before, and that's actually economical for us because the fee we're paying is something like 1/100th of a penny. So it's profitable to do, and we'll just keep doing interest payments that are as small as is profitable for us to do. And I think Bitcoin Cash is really unique in that it is the only transaction system that at scale can handle very large scale while still being decentralized. I think there are a lot of blockchains that handle large scale transaction volumes really fast, but they're not decentralized. And they're not, the actual blockchain nature ends up being the best way to know if a blockchain is decentralized or not is to understand the block time. If they tell you, oh, the block time is 1 second or sub 1 second or something, it's guaranteed that it's run by 10 nodes or 20 nodes that are all on AWS, and they're all just centrally managed, centrally controlled, right? So there are a lot of blockchains that are effectively a version of that, and maybe they're trying to do something that is very niche, some type of niche smart contracting system, and I don't want to disparage that use case of blockchain. Maybe it's fine, but for money, you need the actual core system decentralized, because you want to protect that 21 million limit in order for people to really decide this is something they can trust their life savings into and their capital into. And so that is the power of BCH, is that it is decentralized. It's probably, I would say, tied for first, or peered with BCH, with BTC and Ethereum in terms of its decentralization, but it is actually has massive transaction scale. And so, yeah, I mean, it's great. It can handle these kind of interest payments with very, very large transaction scale in a really, really impressive way.
Well, we're of course very glad that you're taking advantage of it. I think, yeah, it's a useful tool, and it's fantastic to see that the tools are being built on top of the tool. So let's see, is there anything else specifically about CoinFlex or Notes.finance that you have going on right now that you'd like to mention? I did see that there was, for example, an affiliate program, if you'd like to talk about that or anything similar.
Yeah, I think the thing we're probably promoting the most is these interest tokens, and everything we're doing in that space. So I mean, Notes.finance, if you are willing and happy to use the Ethereum smart contract system, Notes.finance is yielding something like 150 to 250% annualized. So I would definitely encourage people to get involved in that. I think over time, one thing we're really excited about is creating interest-bearing tokens for BCH, where you're not earning dollar interest, but you're actually earning BCH interest or BTC or Ethereum interest. So I think that's kind of one of the directions we're going to go down as well. And ultimately, I think what this does is it allows us to be something that's much bigger than an exchange, which is kind of a money platform, or banks are kind of this for the 20th century. This is how money is going to look, I think, in the 21st century. You're not going to have banks. You're going to have tokens that have issuers and that have specific qualities to them. And this is how banking worked in the 1800s. In the 1800s, promissory notes were money. Promissory notes were how almost all of money functioned. And that's why there's an exemption for them in terms of securities laws around the world, because of this kind of historical context of what promissory notes were. But banks would issue them, but also just guilds. If you had a guild of merchants, there would be a common promissory note. There'd be specific promissory notes for different businesses, and these things would trade, and they would trade at discounts and premiums relative to how people were confident in those different businesses. And I think the power of that is, and the power of crypto is, that anyone can issue their own currency. And the power of this is that you start getting people to be more aware of these types of relationships, rather than right now you have this system where there's $1 equals $1, and $1 in Chase is the same as the dollar in Wells Fargo. But this doesn't make sense. $1 in one system, $1 in another system, $1 in another system. These things do trade at different prices. These things are worth different things. These things have different access levels. These things have different values, And so why shouldn't there be markets for them to trade? And why shouldn't these interest rates jack up to where crypto interest rates are? Because right now in banking, you're earning 0 on your money. And here you can be earning 10% plus. So that's what we're excited about. I hope other people are excited about it too. And yeah,
absolutely, yeah. That's an exciting teaser, to say the least. And the vision you have of democratizing or making available these tools to everybody, I think you can't go wrong making sure that people have access to tools that other people already have access to. So yeah, thanks so much for joining me. I appreciate your taking the time. I wish you best of luck with CoinFlex, Notes.finance, and everything going on there. So I assume they can find CoinFlex at coinflex.com, Notes.finance at Notes.finance. Is there anything else you'd like to direct people towards?
Yeah, I'm super available on Telegram. So my Telegram is at Mark David Lamb. My Twitter is the same. So feel free to reach out to me there. We're also on Twitter at coinflex.com. And you can join our Telegram group just by looking up CoinFlex in the Telegram search bar. So get in touch. These products are new. If you have questions, it's normal, and we'd love to hear about them. So we want to make them better and better and better.
Great. Well, thanks again for taking the time.
Thanks so much, John.
And thanks to our listeners and viewers for tuning in. The Unlimit podcast is brought to you by Bitcoin Unlimited. Make sure to subscribe to our YouTube channel and to look for this podcast on your favorite podcast distribution platform.